Hey everyone, welcome back to the channel. Today, we're diving into one of the most powerful wealth-building strategies, dividend investing. You've probably heard that dividends are a great way to generate income from stocks. But did you know they can be the key to retiring early, or even retiring on dividends? That's right. Today, we're going to show you how to retire using the power of dividend investing. In this video, we're going to break it down step by step. We'll explain how dividend investing works, how to build your own dividend portfolio, and most importantly, how you can generate passive income that allows you to retire comfortably. If you're looking to create a steady income stream that keeps flowing long after you've stopped working, stick with us until the end. What are dividends? Let's start by breaking down the most important concept. What are dividends? Dividends are payments made by companies to their shareholders, typically in cash or additional shares of stock. These payments come from the company's profits. If you own shares in a company that pays dividends, you're entitled to a portion of their profits. Usually quarterly, but it could be monthly, annually, or biannually. Imagine you own stock in a company like Coca-Cola. Each quarter, Coca-Cola may pay you a portion of their profits in the form of a dividend. This dividend can be reinvested or withdrawn as income. Over time, especially if the company increases its dividend payments, you can create a stream of passive income that keeps growing. How does dividend investing work? Dividend investing is simple in theory. Buy shares of companies that pay dividends, collect the payouts, and hold on to the stocks for long-term growth. But like anything in investing, there's more to it than meets the eye. Let's break it down. When you invest in dividend-paying stocks, you're typically looking for two things. The dividend yield. This is the percentage of the stock price that the company pays out in dividends each year. For example, if you invest $1,000 in a stock that has a 4% dividend yield, you would earn $40 in dividends annually. Dividend growth. Over time, companies with strong financials may increase their dividend payouts. This can significantly enhance your returns and compound your income over time. The longer you hold on to dividend-paying stocks, the more you can accumulate in dividends. Why dividend investing is perfect for retirement. So why should dividend investing be your go-to strategy for retirement? The answer lies in passive income. When you invest in dividend stocks, you're creating a system that works for you, not the other way around. Instead of selling your investments to fund your retirement, you can live off the income generated by the dividends. Think of it this way. Every time you get paid from your job, you work for that paycheck. With dividends, the companies are working for you. As long as you continue to hold on to your dividend stocks, they'll keep paying you even while you're sleeping, traveling, or relaxing on the beach. The power of compound dividends. One of the most amazing aspects of dividend investing is the power of compounding. Here's how it works. When you earn a dividend, you can either pocket the cash or reinvest it back into more shares of the stock. When you reinvest your dividends, you're purchasing more shares, which means you'll earn more dividends in the future. This compounding effect can significantly boost your wealth over time. Let's look at an example. Imagine you start with $10,000 invested in a dividend stock with a 4% yield. After 1 year, you'd earn $400 in dividends. If you reinvest that $400 and continue doing so for the next 10 years, your returns will be much higher than just the $400 you initially earned. This exponential growth is the magic of compounding. How to start dividend investing for retirement. Now that you know how dividends work, you're probably wondering how to actually get started. Let's break it down into simple steps. Step 1. Set your retirement goal. Before you start investing, it's important to set a clear goal for how much passive income you want to generate by the time you retire. Do you want to retire with $2,000 per month in dividends? $5,000? $10,000? The amount you need to invest depends on your desired monthly income and the average dividend yield of your investments. Let's say you want to generate $3,000 a month in dividends. If you're investing in stocks with a 4% yield, you would need a portfolio worth approximately $900,000 to generate that kind of income. Step 2. Choose the right dividend stocks. When it comes to picking the right dividend stocks, you want to focus on companies with a history of stable and growing dividends. Here are a few tips to consider. Dividend aristocrats. These are companies that have increased their dividends for at least 25 years. These stocks are often seen as some of the safest investments for generating reliable dividend income. Dividend growth rate. Look for companies that have a track record of consistently growing their dividends. A growing dividend means the company is doing well financially, which is a good sign for your long-term investment. Industry and sector. Consider diversifying your portfolio across multiple industries and sectors to minimize risk. Utilities, healthcare, consumer staples, and real estate investment trusts, REITs, are popular sectors for dividend investing. Step 3. Reinvest your dividends. One of the best ways to accelerate your dividend income is by reinvesting your dividends. Many brokers allow you to set up a dividend reinvestment plan, GRP, where your dividends are automatically reinvested into more shares of the stock. This allows you to compound your returns without having to manually buy more shares. Step 4. Build a diverse portfolio. Don't put all your eggs in one basket. A well-diversified portfolio is key to minimizing risk. By owning stocks from different sectors and companies with varying dividend yields, you'll reduce the chance that one poor-performing stock will harm your entire portfolio. The risks of dividend investing. As with any investment, there are risks involved in dividend investing. Here are a few risks to keep in mind. Dividend cuts. Companies can reduce or eliminate their dividends at any time. If a company faces financial difficulty, it may decide to cut its dividend to save cash. That's why it's important to invest in companies with strong balance sheets and a history of stable dividends. Market volatility. While dividends provide a source of income, stock prices can still fluctuate. If the stock price drops, the value of your investment may decrease, even if you're still receiving dividends. Inflation. Inflation can erode the purchasing power of your dividends over time. However, companies that regularly increase their dividends can help offset the effects of inflation. Advanced dividend investing strategies. Once you've mastered the basics of dividend investing, there are some advanced strategies you can use to maximize your returns. Dividend ETFs and funds. If you don't want to pick individual stocks, you can invest in exchange-traded funds, ETFs, or mutual funds that focus on dividend-paying stocks. This gives you exposure to a wide range of dividend stocks, without having to manage each one individually. Covered calls. For more advanced investors, writing covered calls on your dividend stocks can generate additional income. This involves selling call options on stocks you own. While this strategy can increase your income, it also comes with additional risk and complexity.